With tax time coming to an end on 30th of June, there's a few deadlines that I'd like to just remind you about. The first being your PAYG summary. So this is the summary that your employers will send you, summarising what you've earned throughout that financial year and how much tax has been withheld and paid to the government on your behalf. So these PAYG summaries are really important in order to get your tax right. So you need to make sure that you have that prior to lodging your tax return. Generally speaking, the 15th of July will be the deadline for employers to have issued these PAYG summaries. So keep in mind that the first couple of weeks of July, you may not have all the information to prepare your tax return. So if you, like many of us do over this period of time, want to be going away and getting your tax done early, a bit of a treat to the holiday fund, speak to your employer and see if you can organise to get that PAYG summary out straight away. If you have private health insurance, most private health insurance funds won't issue statements until around about the 30th of July, so the end of the month. If you have private health insurance, you will need to be including these details in your income tax return. So you'll need to again have a chat with your fund, find out whether they issue them electronically or by mail. Make sure that your details are up to date with both your employers and with past employers. So once those statements are issued out, we then should be pretty much all ready to prepare tax returns. So at that time, it's all about deductions. It's all about having categories that relate to expenses that you've had to make in order to produce income. So what we need to be doing is we need to be speaking to those employers and we need to be speaking to those private health insurance funds and making sure that information comes out as quickly as possible. Once we get that, we can then look at deductions. Now, a deduction is something that is deductible because the money you spent directly related to the production of income. And that's the secret. It has to directly relate to the production of income. So what that basically means is you had to spend that money because your employer expected you to do so. If that's the case, these items may be deductible. So the first thing is to determine whether or not you needed to purchase this item and would your employer say yes, they were required to have that. If the answer to that is yes, then the next item is can we prove it? So do we have substantiation? And the most common form of substantiation is simply a receipt. So if you can prove the receipt and it directly related to the production of income, in theory that would be a deductible expense. Certain circumstances arise where the entire amount might not be work related and we would apportion this according to the portion that directly related to the production of income. So guys, there's a couple of tips for you in preparation for this tax season. Thanks for taking the time to check out this quick video, guys. If there's anything else that we can help with you or you've got some questions, please leave them in the comments below. Be sure to give the video a like and we would appreciate the subscription. So jump on board, subscribe and turn on those notifications so that we can keep you up to date with some of the latest trends and tax tips of this season. Good luck and happy tax time. Talk to you later.